Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring. Today is Saturday, June 7th, 2025. I hope you are having a nice weekend. I hope you had a good trading week last week, and I really appreciate you taking the time to watch my weekend review podcast. In this podcast, the format is as follows. First, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades and positions that I entered or exited last week. We're going to talk about when I entered them, why I entered them, what were the signals, what were the setups, how I'm going to position size correctly, how I'm going to place my emergency stop, how I'm going to place my end of bar stop, how I'm going to take partial profits if the trade moves in the direction that I want it to, how I'm going to go into trailing stop mode, and then ultimately how I am going to exit the entire trade. So we're going to talk about when, why, and how I'm going to manage the trade going forward. After that, I am going to talk a little bit about trader psychology. The most important skill in trading, the skill is between your ears. It is the psychological portion of it. And really, if you just distill it all down, if you want to be a long-term profitable trader, you need to create a plan, create a plot, a process, and then more importantly, you need to follow it. And really, that's when I say trading psychology, really what I'm referring back to is the ability to create and follow the plan that you made for the trade. And it sounds easy, but it's not easy. And that's why a lot of people use bots to trade for them, because they have a difficult time. But it's certainly possible. You can do it. But it is important. Otherwise, we're humans. We feel different every day. We have different emotions every day. Sometimes we're more patient, sometimes we're less patient, and that will reflect in our trading. But in my opinion, it's always a really good idea to create a plan when the market is closed, because you're in a different mindset. Create that plan, and then if you take the trade, you've already got the plan laid out, right? And then follow the trade. So anyway, I always like to teach trading psychology. It's always helpful for me, and I hope that section will be helpful for you as well. After that, I have gone down through my master watch list. I go down through every Friday night, both on the daily time frames and the weekly time frames. And I have identified some potential trades for next week. Now, these markets are not where they need to be yet, because if they were, I probably would have already taken the trade. But they're getting close. They're getting close, and it's certainly possible that some of them may trigger next week. And it's one of the greatest advantages we have as small retail traders is the ability to look at a chart, look at the support, look at the resistance, look at all the things that we look at big picture on the chart and say, next week, if that stock went down to here, then you'd have this, that, and the other, which would all be a confirmation to take the trade. So that's my process, and that's what I'm sharing with you here each weekend on the podcast, or what I'm looking for next week. Maybe they'll get there, maybe they won't. If they don't get there, then I just don't take a trade. If they do get there, then I potentially think about taking the trade. And sometimes I'm going to have several that are going to trigger or get to where they want. And then that's a whole other thing. Then I have to decide out of the multiple markets that had signals, which one, how I'm going to narrow it down, because I only take one trade per time frame. I take only one trade on the daily. I trade one trade on the weekly per week. So anyway, I hope that is going to be helpful for you. Kind of get an idea of what I'm looking for, how I'm trying to be patient, how I'm entering the trade. And if you find anything helpful in today's podcast or valuable to you, I would really just appreciate it if you could quickly hit the thumbs up button. It helps to build the channel, keep the channel around. And if you haven't subscribed, I would really appreciate that as well. So let's go ahead and run the U.S. legal disclaimer, and then we'll get started with all the stuff.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, thanks a lot for holding through that with me. Let's get started on the current positions that I am in. So I did enter a short position in gold on Thursday, the 5th of June. And the reason that I did was, take a look here, we have some red boxes up here. Well, this right here is a bearish island reversal, and this is a bearish order block. And you can see this big bar over here, the big down bar, really big down bar. When you have big down bars like this, a lot of times you will attempt to rally back to about the halfway of that big down bar. And there's a natural tendency to have a lot of resistance there. And you can see going into the future, that's right about where we got. We did get above a little higher and then straight down. So in this order block, and the reason this is an order block, by the way, an order block, a bearish order block, is when you have a swing high, followed by a swing low, followed again then by a higher swing high, and then you have a big move down, which takes out that swing low. Now the high and the low of this bar here, of this second swing high, this becomes an order block. The high and the low, anywhere in here is, for the way I trade, a shortable area. And what I look for is I look for rejections of the bottom of the order block, like I did here on Thursday. You can see it went in and then rejected it above and closed below. Another area that I was looking for potentially was a rejection of this halfway bar that I draw out into the future, or a rejection of the high of the order block. We don't have one here, but if there is a major moving average like a 200, 250, or 300 that resides inside of the order block, that's also a different level. So there's a lot of different ways to approach order blocks. The rejection of the low, rejection of something like a moving average in the middle, or this line here, which is the big down move, this bar all the way back here on the 22nd, or a rejection of the high. So I got short Thursday at 309.30 because of the rejection. You can see there were two other days that tried to get in this bearish order block here, failed. Wednesday tried to get in, failed. And then Thursday I got short here at 309.30. So now when I get short, and let me quickly show you about position sizing, because really it's the most important part in trading is position sizing, without a doubt. So the way that I position size is very easy, but it works well for me. It takes a lot of things into consideration. But the first thing the first data point that I have to have is how much do I have in my trading account, right? Let's just say I have $100,000. I take 1% of whatever I have in my trading account. If it's $100,000, it's $1,000. If it's $200,000 or $200,000, it's $2,000. If it's $1 million, it's $10,000, right? So let's just say I'm using $100,000. 1% is 1,000. Then I look to the value of the 2 ATR range. Right now that value is 997. So I take that $1,000, which is 1% of my total capital, divided by 9.97. That's telling me essentially to buy 100 shares. And the 2 ATR, what that's doing is it is helping you position size based upon volatility. If the volatility is very high, then this number is going to be much larger, and therefore the amount of shares it's going to have you buy is less. If this is very small and there's not a lot of volatility, then it will allow you to buy more shares. It makes sense. If volatility is very high, you should buy fewer shares, right? If it's lower, you could buy more shares. So it makes sense. All right. So rejection of the negative of the rejection of the bottom of the order block. I got short at 309.30. I bought 100 shares based upon the math I just showed you with the calculator. Now I have to decide two things. I have to decide where is my emergency stop, and I have to decide where is my end of bar stop. Well, my emergency stop is very easy. It's exactly the same value of my 2 ATR up because I'm short here above my entry price. So I got short at 309.30. I just add that number to it and I place my emergency stop above here. So because we did the math, if I have 100 shares and it basically goes up 9.97, basically goes up 10 points, how much have I lost? I've lost $1,000, which is 1% of my account. But the good news is that this only happens about 5% of the time. The other 95% of the time, if you have a losing trade, it will be because of your end of bar stop, which almost certainly always will be much closer than the emergency stop. That emergency stop is just the worst case scenario. And I do want to point out that when the emergency stop is hit, I get out of the trade immediately. I don't wait for the close of the market. My entries for my entries or my end of day stops, I wait for the closing price because the closing price is the most valid price. So that's why I key off of that to make my buying and selling decisions. But if you get to your emergency stop, if I get to my emergency stop, it's immediate. Doesn't matter what time of the day, 1 minute before, 1 minute after the market opens, or 1 minute before it closes. So the emergency stop, 2 ATRs above. The end of bar stop on this trade is going to be a close above the high of the order block. The order block is 315.62. So just show you what I do here. 315.62. I like to have a lot of visuals on my charts instead of notes so that I can just look and immediately know where my lines and things are. So emergency stop, end of bar stop right here. Okay. Now you also see this orange line down here. This is my trailing stop level. This is my entry price minus the value of the 1.5. 1.5 ATR is 748. So I take because I'm short, it's below. So I take my entry price minus 748. I place the 1.5 ATR below. So this is my trailing stop level. And all this means is if it moves in the direction I want it to, 1.5 ATRs, then I have a rule that tells me I need to tighten up everything. And what I mean by tighten up everything is if it does reach my 1.5 ATR, then in the future, if it continues to go down, great. But in the future, if I then have a close above the previous bar's high, then that's my rule to take off half of the remaining shares that I have. And the effect of that is it tightens everything up. It essentially brings this down, it brings everything down. If I were long and I hit if I get to trailing stop level, then I have a close below previous bar's low. It is because I'm selling half, it essentially moves everything up. All right, so everything I've talked about so far as end of bar stop, emergency stop, going into trailing stop mode, these are all defensive moves. So in other words, if the price action goes against me, it gives me, there are rules and things for me to do if it goes against me. But I also like to play offense in my trading, everyone. And the way I play offense in my trading is if the market moves a certain amount from the previous bar's close in my direction, then I take action. So this is a short position, but let me show you exactly what I mean by this. So I take the closing price. The closing price is 305.18. I look at the 0.45 ATR value. It's 224. Now, because I'm short, I take the closing price minus 224. So my first profit target for Monday is 302.94. So my first profit target would be 302.94. That's my first profit target. And at that profit target, if it gets there, I will take off 10% of however many shares I go into the day with. If I go into the day with 100, then 10% at my first profit target, I would take 10. Then I do it again. I take my first profit target minus again the value of the 0.45 ATR minus 2.24. My second profit is 370 cents. So that's my second profit target for the day. And then I do it one more time. Always, I do it 3 times. My second profit target, 370 minus again 2.24. Third profit target for the day, 298.46. And there you go. So if I go into the day with 100 shares, I have 3 profit targets, 10% of however many shares I have, so it would be 10, 10, and 10. And to me, taking partial profits is extremely important. One, it reduces your position size. It locks in profits that the market can't take away from you. It reduces your position size, which if we have a big shooting move back up, then I have fewer shares. So now I'm short on this position. So I minus the number 305.18 minus 2.24. If I was long this position, my profit targets would be 305.18 plus 2.24. Make sense? So anyway, that's how I position size. That's how I place my emergency stops. That's how I play both offense and defense. So one more time, let's just really quickly start. And I'm not going to be this detailed with all the trades, by the way. I'm just this first one just to kind of give you a base. But again, I got short here 309.30 because of the rejection of the bottom of the bearish order block on GLD. Currently, I am not at trailing stop level yet. That's 301.70, but currently this particular trade not doing too bad. Right out of the gate on the short, up 1.36% on the bearish order block. Okay, so that's GLD. Amazon. All right, this one's not working out so well. You can see that I have the red box here. What is this red box? These 3 bars are called a bearish island reversal. And the reason they're a bearish island reversal, is because we gapped up. We had a couple days of sideways motion, and then we gapped down. And usually, well, I should say more often than not, when you have this pattern of gapping up and then going sideways and then gapping down, more times than not, when you look out into the future, those prices will be lower. Conversely, here's an example of the opposite. Here is a island reversal because it's more than 1 bar. Here is a bullish, what we call an abandoned baby. It gaps down and then immediately gaps up. So more times than not in the future, you will see prices higher, which is exactly what happened. If you'd like to learn more about abandoned babies and island reversals, both bullish and bearish, go to my YouTube channel. I have a video there that explains it in more detail. So back to this trade. I got short Amazon here on the 16th of May because we formed the bearish island reversal, and then we gapped up to the bottom of the island reversal and then closed below. So that was my short signal. Now, On abandoned babies and island reversals, it's a little different than what I just showed you on gold. On these two particular strategies only, I make it really easy. I place a 2 ATR emergency stop above, and I place a 4 ATR profit target below. I put them in as a OCO order, or one cancels another. And one of two things is going to happen on this trade. I am either going to lose 1% if I'm wrong and it goes up, or if I'm right, I'm going to make 2%. And that's correct trading. Asymmetrical risk. Risk less than what you potentially have to make on the upside. So this is a 2 to 1. I'm risking 1 to make 2 after a setup where when you back test it and you look at it, more times than not, it is correct. So more times than not on these particular setups, I make twice as much as what I'm risking, but not always. I mean, you can see on this particular trade, it has just been very strong. Now, I'm not to my emergency stop yet, but I just let this play out. Whether it hits my stop, whether it hits my profit target, I just don't mess with it. This particular trade right now, the short trade, down 3.55%. So that's Amazon. All right, let's go to UNG. UNG has been an interesting trade. It's been a good one. You can see this this green box down here. This is a bullish order block. Why is it a bullish order block? Well, we have the pattern back here. We have a swing low, followed by a swing high, followed by a lower swing low. We move up through that first swing high. This now changes market structure to the upside. When market structure changes to the upside, I buy any pullbacks back into the order block. And the order block is the lowest bar close right before market structure change. So we have a swing low, a swing high, a swing low, market structure change. As soon as this market structure change happens, I know this is the swing low because it's the lowest bar close right before market structure change. I take the high and the low of this bar, I run it out into the future, and if it gets back into this area, I will buy, right? So take a look. We broke market structure here. We went up and up and up and up and up and up and up. Well, on this particular day, if you looked back to this bullish order block, you would think, well, in hindsight, there was some pretty smart money buying here. Clearly, right? So if then in the future we get back to that smart money area, I'm going to consider buying. Now, just because it was smart money on this day doesn't mean it's smart money in the future. Something could have changed, right? The industry could have changed. Politics could have changed. But more times than not, it is the correct place to potentially enter a trade again. So I didn't buy this breakout here and the structure change, but I bought the pullback and the rejection of the high of the order block on the 19th of May. I got long 1566. So I placed my emergency stop, as always, 2 ATRs below. My end of bar stop is just a close below the low of the order block at 1504. I placed my 1.5 ATR trailing stop level above my entry. And if it moves up day to day, at least 0.45 ATRs from the previous bar's close, I take profits. Well, look what happened. Nailed it at 1566, rocketed up. I hit multiple profit targets on this day. I can't remember how many. I think it was 4, actually. So I had a huge day, and then I also got to trailing stop mode. So now I'm in trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a close below a previous bar's low, I'm going to exit half. Next day, nothing much happened. And then here on the 22nd, it closed below the previous bar's low after reaching trailing stop level, I sold half of the remaining shares that I had for a gain of 6.01% from here to here. Now, the best thing about selling half, everyone, is if you sell half and it goes down, you're glad you sold half higher. If you sell half and then it continues up, you're glad that you still have half. So after I sold half, we rallied a couple days, had a profit target, then we had 3 big down bars. Look, got right back exactly almost to my entry point, and then went up again. Here on the second, big move up again, multiple profit targets, 3 days of sideways motion, and then on Friday, move up again, more profit targets. So the remaining shares that I have on this particular trade, doing pretty well, up 8.79%. Okay, so those are the 3 current open trades. The gold short up 1.36, Amazon, the short trade down 3.55, and UNG, the long trade 8.79%. So these trades are still open. Let's go to the closed daily trades that I have. And I'll tell you, this is a really good example of what happens to traders. It's frustrating. I'm sure you've been there. But let's take a look big picture why I entered this trade first. Well, this is Exxon. Here you have your green block. Why a green block? Because it's an order block. It's a bullish order block. You have a swing low, you have a swing high, you have a lower swing low, you break market structure to the upside, defining this bar as your bullish order block. The high is 103.70, the low is 102.13. These are the parameters of the order block going forward. And so I bought here, and again, after it breaks market structure, I'm not chasing that break. I'm I'm waiting for a pullback into the bullish order block. Well, this is right where we came back into. I got long here on Exxon at 102.31 on the 30th of May because during the day we went below the order block and then closed back in it. It's a really good risk to reward ratio because look how close I am to the bottom of the order block. If it then in the future closes below the order block, I'm out for a very small loss, which actually is exactly what happened. But this is a good opportunity and a good teaching moment to show you why taking the partial profits for me is so important, because look what happened the very next day. Gapped up. I hit multiple profit targets right off the bat, right? Lock those in, market can't take it away from me, and it reduces my overall position size. The very next day, up again with multiple profit targets, right? So I have multiple profit targets. I think I hit 2 here and I hit 2 here. So that's about 40%, a little less than 40%. And then the next day up again where I hit another profit target, I didn't quite get to trailing stop mode. And then look here on the 5th, what happened? It closed below the low of the order block. I had to get out for a very small loss of 0.48%. And the reason why it was such a small loss was because I got it so close to the end of our stop. And then what happened? Look at Friday. Took right off. Listen, it's going to happen to you in trading. It happens. You get out, and then it goes rocketing up. I followed my rules. I have to be happy about that, pat myself on the back for that. Because had I stayed in this, and then it rocketed up, how does that change my thinking? It makes me change my thinking to the point of, well, I didn't follow my rules and get out when I was supposed to, but it was still okay. So you're more than likely to do it again in the future. Just don't do it. It will lead you down a rocky road with this kind of thinking. All right. So, but overall, yes, lost 0.48%, but didn't really lose 0.48% because I hit so many profit targets up here. And again, that's why it's important for me to take partial profits. And then it just ripped up higher. But I'm sure you've been there. It's frustrating, but still the overarching idea here is this is going to happen, but do not let it make you not take your stops. Look, if you take your stop, I can always get back in. I didn't get back in, but I could have, right? So this one, loss of 0.48%. Google, G-O-O-G-L, Google, I closed this trade out on the 2nd of June. Why? Well, let's start with the beginning of the trade. Goes all the way back here. I got long Google on May 7th. I got long at 151.47. We have a bullish order block. We came down into the order block. We rejected the high of the order block. That was my entry. My end of bar stops, a close below the low of the order block. And of course, I have my 2 ATR emergency stop all the way below. As soon as I entered, I placed my 1.5 trailing stop level at 159.50. And if it moves up, I'm going to take partial 0.45 ATR profit targets. The next day, it did gap up. I took a profit target. Next day, nothing. Next day, gapped up again. More profit targets. Next day, not sure if I hit a profit target on that day. But on this particular day, it reached trailing stop mode. So now I'm in trailing stop mode, meaning that in the future, if I have a close below a previous bar's low, I'm going to get out of half. Next day, rocketed up again. More profit targets. Next day, nothing. Next day, up again, more profit targets. Next day, up a little, no profit targets. And then here on the 20th of May, we have our first close below a previous bar's low. After reaching trailing stop level, what do? I take off half of the remaining shares that I have. And that's what I did, and I locked those in for a gain of 7.56%. The next day, huge up again, more profit targets. The next day, up again, more profit targets. Now, at this point, we're starting to get extended. We are above the 65 RSI. If I'm ever above the 65 RSI and then I close below the 5 EMA, that is the rule for me to exit the position. I did that here on Monday at 169.03. You can see we have a close below a previous bar, a close below the 5 EMA. That's my signal to exit the entire trade, and it was a really good trade. So the remaining shares that I exited there, gain of 10.38%. Again, all based upon the bullish order block. And then it continued to go down, and then we've ripped right back up, but that's fine. So anyway, really nice trade there. Exited the trade with the close below the 5 EMA. And then last but not least on the daily is DIA. Okay, you see the red box. That means that I was looking for a short in a bearish order block. Why is this a bearish order block? Because we have a swing high followed by a swing low, followed by a higher swing high, then a big move down that takes out that swing low, market structure break. This bar here now, the highest up bar close before market structure change to the downside, defines the bearish order block. I got short here on the 28th of May for two reasons. One, we rejected the bottom of the bearish order block, and we rejected the 200-day moving average, which is the black line. Really strong signal. The nice thing about having a major moving average in the middle of the order block is that it gives you a better risk to reward ratio. So instead of me having to wait until a close above the high of the order block for my stop, I just wait for any close above the 200, which happened here on the 3rd of June. It did close above the 200-day moving average, and I got out. I got out for a loss of 1.01%. If I use the high of the order block, you would see I would be down more than that, although I still would be in the trade because it did not close above the high of the order block. So we'll see what happened. But this one didn't work. But listen, not every signal works. You have to look at it like this. I take this particular trade. Would I take this trade again? Yeah, of course. Because if I were to take this trade, this exact same setup, if I were to take this exact same setup 100 times, more than likely, more than 70% of the time, this would have turned out profitable for me. This was one of the times where the 30% did not, right? Not going to be profitable 100% of the time. But over time, if something is going to be profitable 70% of the time, and I'm making more money when I win than when I lose, I'm going to take that every time. So I would take this every single time, but this one just didn't work out, right? So a loss of 1.01%. Okay, so the 3 daily close, Exxon, loss of 0.48%. Google closed out for a gain, remaining shares of 10.38%. And DIA on the short, a loss of 1.01%. Okay, so those are the daily opens and the daily close. You can see that not all of those trades are positive, but the takeaway that I want you to understand is that the losses, all in all, pretty small. The gains higher than the losses, some of them much higher than the losses. And that's really the best you can expect for trading. Having a large gain is great in trading. Having a small gain, totally great, totally acceptable. A break-even trade, totally fine. A small loss, totally fine. But what you want to stay away from are the big losses. That's what's going to mess you up and mess up your account. So, when you look at these trades, you'll see, yeah, there were some big gains. There were some small gains. There were some kind of close to break-even trades. There were some small losses, but you didn't see any big losses there. And that's the key. Over time, that's how you make money in trading. Okay, so in addition to daily charts, I also like to trade weekly charts. It just gives you different structures. It gives you different opportunities time-wise. I got short the Qs on Friday, right here at the close of the market. Why? Well, you see the red box up here. This is a bearish order block. Why? Because you have a swing high, and then you have a swing low, and then you have a higher swing high, and then you take out that swing low, clearly, structure change to the downside. So I don't short with this move down, but it now defines the high and the low of the order block going forward. The high of this box is 538.85, the low is 521.95. You run that out into time, and if the markets come back and reject either the bottom of the order block, reject some other level inside the order block, or the high of the order block, that is the short signal. So I identified this 533 as my level inside of the order block. Why 533? Go back here to the 21st of February, big down bar. If you have a big down bar and you rally back to halfway of that big down bar, which is exactly 533, that's it. Had we closed above it, I would not have done anything. But we essentially got to the penny this week to the halfway of that big down bar there. It actually went over 5 cents. It got to 533.05, but it rejected it. So I got short on Friday, right at the close, at 529.92. I position size. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs. I'm sorry, my emergency stop 2 ATRs above, because this is a short, and then my 1.5 trailing below, again, because this is a short. And where's my end of bar stop on this? Well, I have two options. One, a close over the high of the order block at 538.85, or what I'm going to use is this 533 level because it's closer. So next week, if we close above 533, I'm just going to have to get out. If it closes at 533 and 1 penny, that's my signal to get out of the trade. All right. So this is a exactly break-even trade, brand new trade. So this is why I have QQQ. This is why I shorted QQQ. Rejection of the halfway move down that resides inside the bearish order block on the weekly. And because this is weekly, I don't touch it until Friday. Unless, of course, we get up to trailing, or we get up to emergency stop, at which point I get out of the trade. But other than that, I wait till Friday to make my decision. So that's Q's, completely break even. Nike, okay, Nike is also a weekly trade. This particular, look, there's a difference between how the daily looks and how the weekly looks. So that's why I like to trade both dailies and weeklies. It gives you different opportunities even on the same stock. So I got long Nike on the 18th of April. Why? Well, this is, you don't see any green boxes. There's no order blocks. This is a simple deep dip buy. In a deep dip buy, deep dip buy has to do with the 30 RSI or the major moving averages like the 200, 250, or 300, right? I have a course on deep dip buys on udemy.com. If you'd like to check that course out, I've sold so many around the world. It's very affordable. It's 9.5 hours of video, and the link's in the description of this YouTube video. But I love deep dip buys. I really, really do. And this is just a perfect deep dip buy from a RSI perspective. I bought this at 55.80 here on the 18th of April. So I've been in it for a while. Why did I take this trade? Because during the week, the RSI reading on the weekly was under the 30 RSI, but it was strong enough to close above the 30 RSI. In addition to that, we have the negative third ATR channel, which is the gray line here. We also, during the week, went under the negative third ATR channel and closed back over the negative third ATR channel. Now, it's important to know I did not take the trade because it went under the negative third and over the negative third. I took the trade because it went under the 30 RSI and over the 30 RSI. And the fact that it went under the negative third and closed over the negative third just helped reaffirm the trade and give it some more credence. It just improved the quality score of the trade. All right, so I got long at 55.80. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 30 RSI on a weekly basis on Friday. So if you go back to when I bought this, look, it closed at 30.7. You see how close I am already to 30? So the next week, had it closed at 29.99, I would have simply gotten out for a small loss. But it moved my way, thankfully. So under 30, over 30, rejection of the negative third ATR channel, position size, emergency stop 2 ATRs below, end of bar stop, a close below the 30 RSI. I placed my 1.5 ATR trailing stop level 1.5 ATRs above, and if it moves up in the meantime by the value of 0.45 ATR on the weekly, I'm going to take partial profits. Next week, it did move up. I took some partial profits, hit some profit targets. Next couple weeks sideways, nothing happened. Then here we had a nice move up. I believe I hit 2 profit targets on that particular day. And I also got to trailing stop level. You can see, got right to the orange line. Now I'm in trailing stop mode, which means in the future, if I have a close below previous bar's low, I'm going to exit half. The next week, it did close below the previous bar's low. After reaching trailing stop level, I sold half of the remaining shares for a gain of 7.20%. And this week, I hit another profit target as it moved the value of 0.45 ATRs from the previous bar's close. The remaining shares here I have on Nike 11.10%. So not bad, right? Really good risk to reward ratio. I was patient, waited for the trade, followed my rules. That's the important part, everyone, about your rules. You got to have a process. You got to have a process, and you got to have a plan for your trades. That's just you need to find it. Listen, I teach private one-on-one lessons. I teach people from all over the world. I've taught for many, many years. I love to teach. I've turned out some excellent traders, and in my one-on-one course, like I said, it's one-on-one, the best way to learn. It's a 15-hour course. I teach you all the different trading approaches that I use, step by step. We do all sorts of simulation trading. I throw a lot of curveballs at you. It's very important that my students become good traders. It's very important to me. That's why I got into teaching from 30 years of trading, because I like to teach people a new skill. So if you'd like to study with me, if you'd like to be my student, I will teach you everything I know. My email is in the link of this YouTube video. Just send me an email, and I'd be happy to have an initial call with you, and we can talk and see if we are a good fit. But boy, I've had so many students lately, so many great students, really, and I really like to see them with their trades. And I'm going to show you one. My student Steven had a great trade, deep dip buy trade on AGQ. So if you're interested, I'd love to speak with you. Just send me an email. So Nike, the remaining shares up 11.10%. And now the last trade, there's always got to be one, right? And it is TLT. I have been in TLT for seems like 85 years. I bought TLT with a deep dip buy back here on the 17th of January, which seems like a million years ago. Why did I buy here? Well, we have a bullish order block. We rejected it, closed back above. I got long here, 87.20. My emergency stop, 2 ATRs below. My end of bar stop, a close below the low of the order block at about 82.71. I placed my 1.5 ATR trailing stop level above, and away we go. Next week, up a little. Next week, up a little. Next week, up pretty good. Hit some profit targets. Not yet to trailing stop level. 2 weeks of sideways motion. Nothing going on over there. Next week, up nicely, up big. Profit targets and also a trailing stop level. Then we have a month sideways where really nothing happens. Then we have one big bar up here on April 4th. I hit some profit targets, thankfully. Remember, I'm in trailing stop mode. And then we had the big collapse where bonds just crashed down, and it went down, and I was in trailing stop mode. So did this close below this low? It certainly did. And what did I do? I had to take off half of the positions because I was in trailing stop mode for a loss of, not bad, 0.59%, right? So kept the loss small, and the reason it was small because it went up so much before. Then we had this week up here where I hit some more profit targets. The next week again, some more profit targets, thankfully, and then down for the last month, and then sideways, and again down this week. So this particular trade, the remaining shares on this trade, down 2.21%. But do you understand now in hindsight how important it was that I took the partial profits when I had them on the way up, and the close going into trailing stop mode and having the close below the previous bar's low? That saved me as well. And then this little rally here where I reduced more shares at profitable levels before this happened, right? So a lot of different ways how taking partial profits can be helpful. So the remaining shares on TLT down 2.21%, but this is just one of those trades. It has not told me, my rules have not told me to get out of the trade. And at the very least, I'm making some monthly dividends from TLT as well, right? So, okay, those are the open weekly trades at the moment. Again, QQQ, the new short position based upon the the level inside the bearish order block. That one's even. Nike remaining shares up 11.10%, and TLT remaining shares down 2.21. Okay, that was a lot of positions. A lot. All right, let's talk a little bit about trader psychology, and then we will start talking about the potential trade setups for next week. Okay, this is a nice post here from Tony Stark over on Facebook. Boy, Tony posts some really great things. Thank you very much, Tony. This is from Peter Robbins. If you don't know who Peter Robbins is, he's a smaller retail trader, but he was featured in the Market Wizards book, the Unknown Market Wizards book. When I say small retail trader, it's probably not small to you, but compared to like large financial institutions. But let's see he's a great trader, really good insight. And look, when somebody like that, such a successful trader, gives some advice, maybe it's good to take a look and at least consider it. Approaching the market as a humble trader will help prevent you from being a humbled trader. Make sense? If you go into this business as a cocky know-it-all, oh yeah, market's going to do this, should do this, I'm just telling you from 30 years of experience, you're going to end up a humble trader. But if you go into the market with a humble attitude, with an attitude of, I'm not really sure what's going to happen, I better be safe, I better follow my rules because I don't have any predictions, I don't have any biases, that will help you from being a humble trader. Listen, I know a lot of traders. I deal with a lot of traders on a daily basis. Students, other traders that I work with, consult with. And the ones that always end up doing the best are the ones that don't have ideas and predictions. Listen, I am talking from experience. I started trading in my mid 20s. I had a lot of money, I had a lot of testosterone, yet I didn't know anything about trading. But that didn't stop me. I was sure this was going to happen. I was sure that was going to happen. I've lost a lot of money, which ultimately was a blessing because that's what made me go out and study with some of the best traders all over the world, right? That was the wake-up call. I need to figure out really how to do this. And doing all that made me a really good trader. But I got humbled. So when I hear other traders that I know talk about, don't you think that this should happen or this will probably happen? Oh, for sure that can't go up anymore. For sure that can't go down anymore. Oh my gosh, when I hear that from traders, it's like nails on a chalkboard to me because I know how inaccurate it is. I have a student, I'm not going to mention his name, but I could just tell by the way that he spoke that he was very humble. And I told him when we first started to speak, I said, I can just tell that you are going to be a good trader. He goes, how do you know this? You hardly know me. I said, I can tell by the way that you speak. I can tell by the words that you use that you're not a know-it-all. I know you're going to follow your process. And I'm certain he's going to be a great trader. But if somebody comes to me and says, well, the market's going to do this, the market's going to do that, I worry about that trader, right? Because it reminds me of me when I was younger. So just to sum up what Peter Robbins says, approaching the market as a humble trader will help prevent you from being a humble trader. Don't be a humble trader, everybody. Have an open mind that the market can do whatever it wants to do. It can go much higher than you think it's going to do. It can go much lower than you think it's going to go. But if you approach every day with, I have my plan, I'm going to follow my plan, and I'm not going to let my biases or predictions interfere with my plan, you're going to be a much better trader. So stay humble. Stay humble and become a better trader, or be cocky and become a humble trader. Anyway, Peter, thank you very much. It's a great quote, and there's so much meaning to this. And the more you trade, everyone, you'll understand why this saying is so important. So anyway, thanks again, Peter. Okay. Every time we talk about trading psychology, I go off on a rant, but that's okay. That's what I do. Okay, let's take a look at the potential trades that I'm looking at next week. Okay, so I mention this every single time, everyone, but look, here on the daily time frames, I have 8 potential markets for next week. Theoretically, all 8 of these trades could signal on the same day. So does that mean I am going to take all 8 trades on the same day? No, I only take 1 trade per time frame. So if all 8 of these signals signal on Monday, I'm only going to take 1. How do I decide which one's the best? Listen, I look at many things. How many confluences of signals does each market have? If I have 3 signals on one market and I only have 1 signal on the other, which one do you think I'm going to take? I'm going to take the one that has the most confluences, combinations of signals and setups. I'm also going to look at the risk to reward ratio. It's very important. I'm going to look at things like MACD. Do I have MACD divergences, ATR divergences, RSI divergences? I'm going to look at multiple time frames. I'm going to look at the higher time frame to see if there's some kind of supporting support and or resistance at the higher time frame. I'm going to look at the relative strength of that particular market compared to the market in general. So again, these are what I teach my students, how to differentiate and how to narrow down the best trades based upon multiple confluences and other things like I talked about, like higher time frames and relative strength. All right, so keep that in mind. So again, if you would like to learn this from me, if you'd like me to become your teacher and your coach and your mentor and teach you everything that I know, just send me an email. It's a 15-hour course. We do it in the evening times, and I really think you're going to be glad that you took the course. I don't think I've ever had a student that has not been happy that what they have learned. So my email's there. Just send me an email and we can start the conversation. Okay, let's start with Alibaba here. Okay, so Alibaba, there's a couple potential areas here on Alibaba, but the first one that I want to concentrate is potentially on the long side. But again, we're not there yet. We have a bullish order block here from this bar. The high is 109. The low is 97.75. It's a very wide order block, which I don't like because it's not good for a good risk to reward ratio. But really, my favorite trade, I've had many people say, Greg, what is your favorite trade? And I said, my favorite trade is a deep dip buy that resides inside a bullish order block. And this is exactly what we have on Alibaba. Look, we have a 200-day moving average here inside the bullish order block. We also have a 250-day moving average inside the order block. Somewhere down here, we'll probably have an under 30, over 30 RSI, which would reside inside the order block. So that's my favorite trade. But the thing is, you have to be patient and wait. It is not there yet. Probably won't get there next week. However, if it does, that's what I would look for. So what I'm looking for next week is a rejection, a close under, close over, bounce, intraday rejection to the 200-day moving average. Then I'll use that 200-day moving average as my line in the sand. Or if we lose the 200 and even go lower to the 250, I could key off there, or at the bottom of the order block at 97.66. Percentage-wise, it's very unlikely we're going to get down there, but it is possible. So that's what I'm looking for. Unlikely to happen, but if it does, I'll consider taking the trade. Let's look at Berkshire Hathaway. Okay, Berkshire Hathaway is a little bit more realistic. We have a very wide, huge order block here. Why? Because we had a swing low, we had a swing high, we had a lower swing low, and then we actually took out the swing high, which defines this swing low as the order block. But I'm not going to buy here and have my end of bar stop here, but look at the 200-day, the black line. It is running right into the bullish order block. One, I like it because it's a bullish order block. Two, I like it because it's the 200-day moving average. Doesn't mean that it has to respect the 200-day moving average, but it gives you, again, a good structure, a way to structure your trade. If it rejects on Monday, if it rejects the 200, closes above, okay, great. I'm bullish until it closes under. If it closes under, I'm bearish, right? So two areas to look at here. The 200-day moving average inside the bullish order block, or if we go even lower, 250-day moving average still inside the order block. And again, we're at 38.65 RSI right now. There will be some type of, if we continue lower, some kind of under 30, over 30 as well. And you know, I was teaching one of my students this week, and we were talking about major moving average bounces. And look, first stop here is the 200-day moving average, black line. Kind of a good, a good approach to have is if you're looking at, should I buy some kind of rejection of the 200-day moving average? Look in the past for the last time price was at the 200 and see how it reacted. Well, look, it reacted about to the penny. So clearly buyers, a significant amount of buyers, came into Berkshire Hathaway at the 200. So it respected it last time. Does it mean it's going to respect it this time? Not necessarily, for sure. But do I think it would improve the chances? Yeah, I do. I think it would improve the chances that if you get to a level that was respected last time, it's more likely to be respected this time. And I'll tell you one other thing that I notice on this chart. Yes, we are dripping down to the 200. And if it rejects it, very likely I'll take that trade. But what I like is that we're dripping down slowly. That will give you, in my experience, if you drip down to the moving average, more often it will bounce there and be able to go back up. When you have these waterfall moves down here to the 200, even though this one was respected, I got to give it that, those are less likely. But I like the slow drip move down to the 200. So I'm going to be watching Berkshire very carefully, rejection of the 200 or a rejection of the 250-day inside the bullish order block. Remember, my favorite types of trade, deep dip buys inside a bullish order block. FedEx, FDX. Okay, here's a very small, skinny little order block right here. We have a swing low followed by a swing high, lower swing low. Market structure change to the upside, defining the bullish order block here. We are not there yet. I don't know if we'll get there, but if we reject the high of the order block, yeah, I would probably consider taking that trade because the risk to reward is so small because the order block is so narrow. So next week, if we reject the high of the order block at 211.06 or even the low of the order block 207.81, I would consider getting long there. Home Depot. Okay, well, Home Depot, you can see we have a bearish order block. Why bearish? Because we have a swing high, swing low, higher swing high, market structure change, defining this as a bearish order block. Would I take this? Hey, we rejected the order block on Monday. Would I take this? Of course not, because the risk to reward is horrible. The risk is so high because that order block is so wide. So what am I looking for? Look, it's not very likely that it's going to happen, but if I could wave a magic wand of where I would want to get into this trade, it would be right here. It would be here at the 200. If we rallied back up, rejected the 200 above us, giving me a very well-defined risk to reward ratio line in the sand, that's it. Otherwise, I'm just not going to mess with Home Depot unless that exact thing happens. And is it likely to happen? No, it's not. But if it does, it would be a good setup that may still not work, right? So again, sitting, waiting for a good setup, looking exactly like I'm doing right now. That would be a really great setup. Bearish order block, rejection of a major moving average. I'll just watch it. If by some chance that happens, okay. And I'm going to show you a trade on the weekly bars on Tesla where that may just happen. Okay, next one, IBB. All right, IBB, we have a bearish order block. It's been strong. Why is it a bearish order block? Because we have a swing high, we have a swing low, we have a higher swing high, we have market structure break. Defining this here as the order block, running that out into the future. You can see the last 2 days, we rejected the bottom of that order block. We rejected the bottom of the order block. I didn't take that trade. But now we are in the order block. So really, what am I looking for here? About the only thing that I'm looking for on IBB would be really a rejection of the high of the order block at 128.08. Don't know if it'll happen, but if it does, I would prefer the high of the order block, obviously, because the risk reward's better. McDonald's. Okay, so McDonald's, I have a feeling next week, one way or the other, this is going to trigger. We have a bullish order block. We're inside of it now. Why? Oh, 1 second here. My charts changed. Oh, yeah. Boy, my apologies. When I looked at this earlier, I actually drew my order block wrong. Huh. Well, it technically triggered. Okay, let's define the order block. Swing low, swing high, lower swing low, market structure change. Here is your lowest bar close before the market structure change. Run that out into the future. Boy, I apologize. I drew this wrong for some reason. And yeah, that actually would have been a potential entry on Friday. I don't think I would have taken it. But moving forward, what I really like, now that I look at this with a little different view than I did 25 seconds ago, because this was wrong, is that look at the 100-day moving average. That's the red line inside of this bullish order block. If we move down, reject that 100-day moving average, that would be a good setup for me. Doesn't mean it would work, but it would be a good setup because it's a good risk to reward ratio. You have a moving average inside a bullish order block. So the thing is it going to get there? I don't know. It already bounced and rejected the high of the order block on Friday. May go up from here. Maybe. That's great for people that own McDonald's. But if it does go down, if it goes down, rejects the bottom of the order block and or rejects the 100-day moving average, that would be a setup that would be interesting to me in good risk to reward ratio. Merck. All right. Well, Merck has a new bullish order block, and it's here in the green. Why? Well, we had a swing low. We had a swing high. We had a lower swing low, and then 3 days ago we broke structure by taking out that swing high, defining this as a bullish order block. Now, would I buy a rejection of the high of the order block? Probably not, because the order block's pretty wide. What I really am keying off of here is the 76.30 level. Why this? Well, on this day here on the 3rd, you had the nice big strong up bar. If you move down halfway of this up bar, you will find some inherent support at halfway of big bars if you revert back to halfway from a Fibonacci standpoint, and that also resides again inside the order block. If you have any type of signal inside the order block, to me, fairly valid, because the order block just by itself is so strong. So what I'm really looking for on Merck is a pullback and rejection next week of 76.30 because it resides inside that order block. VIX, haven't talked about VIX for a while, but it's starting to be a little interesting to me. I don't have an order block here, but what I do have are 3 major deep dip buy moving averages. We have the black line, which is the 200. We have the orange line, which is the 250. I'm sorry, the 300. The purple line, which is the 250. Last time it got to the 200, you can see it rejected that 200 and had a nice move up. Well, now we're back down. I considered actually buying this on Friday, but it closed under the 200. So next week, moving forward, if we close back over the 200, I would consider it. If we move lower and reject either the 300 or the 250, I would consider it. But what really stands out to me here, other than the moving averages, is the MACD. Look at the MACD bars. These are the deep red bars here. You have this huge move down. MACD bars are down, 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 very, very deep. Well, then we have a rally. And now we are lower here than we were over here. However, even though we're lower here, do you see how we don't have any red bars? Yeah, so when I studied one-on-one with Dr. Alexander Elder, this is called a double bottom with a bullish divergence and a missing right shoulder, because you don't have any green bars on the downside. So what does MACD do? It just measures the momentum of a move. And even though this move looks substantially down, from a MACD perspective, the momentum is not keeping up with this previous move, which means that you could perhaps be running out of sellers, which means that there's a possibility we will have a move up. And by the way, if we have a move up in VIX, what do you think is going to happen to the market? Very likely, if the VIX moves up substantially, the market will move down. And you can see a lot of the positions that I was talking about that I'm looking for next week are potential shorts, because we are getting back up to those bearish order blocks. So look, the market can run longer than we think, right? And that is very, very true. But all I can do is base things off the technicals. And look, if VIX closes above the 200, doesn't mean it's going to go racing up, but it's a start. And we have the support of the 200 below us. Okay, so those are the dailies. Let's get to the weeklies, and then we'll wrap this up. All right, unlikely to happen, but here we go. Here's Apple. On the weekly charts, here we have a bullish order block. Look, 250 week moving average inside the bullish order block. Gets down there, yeah, you bet. I would certainly consider taking the trade. The 200-day moving or 200-week moving average is not inside the bullish order block, but would I still take a potential weekly entry trade off the 250? Yeah, you bet. Is it likely to get down there? Not likely. Not likely at all. But I still like to look at these things in the future and define my positions and my areas of interest and my interests next week. If the unlikely happens and we reject the 200 or the 250, that would consider getting long there. ARK, ARKK, ARK, big move up this week. Big move up into a bearish order block on the weekly. Here's my red line. What is the significance of that? Look to the left. Look at the bar we had here on the 21st of February. Huge down bar. Remember what I told you. When you have a huge down bar and then you rally, if you get back to the halfway of that huge down bar, that's generally an area of significant resistance. Well, that is the case. We're not there yet, but this big down bar also resides inside a bearish order block. So next week, if ARK rejects the halfway mark of 64.20, I would consider getting short there, depending on the risk to reward ratio. And my line in the sand, my end of bar stop on this weekly would be a close back above 64.20. Goldman Sachs. Again, bearish. Why? Because we have a bearish order block. And again, we have the big down bar here on the 21st of February. Big down bar. If you rally back to halfway of that big down bar, just that itself, there's going to be inherent resistance, but it also resides in the order block. Now, on Goldman Sachs, if we reject the bottom of the order block and it gives me a decent risk to reward ratio, meaning that it slightly gently rejects the bottom, I would consider shorting that as well, not having to reject the halfway of the big bar at 641, but my line in the sand would be 641. So I'm open to the fact of rejecting a low of 633.33 or rejecting 641, and if it closed above 641, that would be my line in the sand and my stop. Love, Southwest Airlines. Okay, big red order block, 200-week moving average living inside the order block. Look what we did. we closed over the 200. Had this rejected the 200 on Friday, very likely I would have got short Love, Southwest Airlines, and my stop would be a close above. Next week, if we close back below the 200-week moving average, I would consider getting short there. Or if we go higher and reject the high of the order block at 34.89, I would consider getting short there as well. Meta, META, very well defined order block. Look, the big bar on 221, the big down bar, halfway of this down bar, the red line, also coincides actually with the low of the order block. So that is a massive area of resistance right there. Doesn't mean the price can't get through it, but that's a massive area of resistance. So I'm going to watch Meta really closely. If we reject 709 on the weekly, I will certainly consider taking the trade. And what would be my end of our stop? Probably 709. And if it goes higher from there, I can try with a high of the order block at 740. Morgan Stanley, it's going to look very similar to Goldman Sachs, and it is. We did reject the bottom of the weekly order block already on Friday, but again, I did not take this because it's a really big risk to reward to the top of the order block. So my level that I'm keying off is 135.10 for a potential short on Morgan Stanley. The SPY, okay, I already got short the Qs, but on the weekly time frame, the SPY, again, we rejected the bottom of the weekly order block already, but here you have at 605 is the level back on the 221 again, the big down bar. If we reject 605 on the weekly, I would consider getting short the SPY on the weekly, and that would be my end of our stop at 605. Tesla. This is interesting. Obviously, all sorts of drama with Tesla. And with Tesla, we have a bullish order block. Again, why a bullish order block? Well, we have a swing low, followed by a swing high, followed by a lower swing low, followed by a big up move that changed market structure to the upside, defining the order block here in green. I was teaching, one of my students, we were talking about Tesla, and he said, where would you, as far as a long signal, what's one of your favorite long signals? I said, well, it would be on Tesla, but it would be all the way down here at the 200-week moving average inside the bullish order block. And he said, well, it's impossible that it could get there. And I said, well, unlikely, but it's possible. It's always possible. And now look what happened to Tesla this week because of all the drama with President Trump and Elon Musk. Well, I don't know if it's going to get there. But the reason, in addition to the 200-week moving average being inside of the bullish order block, I have the line here at 256. What is that? Look here. On the 25th, we had this huge up bar. If you have a huge up bar and you retrace back to halfway of that, there's usually some inherent support there. So it's all coming together right about here. Why? One, first, you're in a bullish order block. Two, you're retraced halfway back to the halfway of the big up bar. And three, you have the 200-week moving average there, which would be, for me, a really good area to structure my trade. If it rejects the 200-day moving average, certainly going to consider taking that trade. My stop would be a close under the 200. But again, keep in mind, the big up bar, halfway the big up bar drawn into the future, dovetails with the confluence right there about 256. So we'll see what happens. The dollar, UUP. Everyone hates the dollar. Well, I don't, because I have a nice long-term bullish order block on the dollar, and it's a narrow one, and the 200-week moving average is creeping and lives inside the order block now. So rejection of the high of the order block, I would consider that. Rejection rejection of the 200-week moving average, I would consider that. The rejection at the bottom of the order block, I would consider that. And you can see a couple months ago, where did we find a bottom? Right in the order block from the past. So I'm going to be watching the dollar. And last but not least, everyone, XLF. We have a bearish order block here on the weekly. We have the big down bar on March 7th. We were able to close above it really strong. So from here, where do I go? Potentially, if we reject the high of the order block there, it looks like the high of the order block was 52.26. We're at 51.29. We're getting very close. So if next week we rejected the high order block and close back in, I would certainly consider taking the trade because of the risk to reward ratio. So, whew, man, I feel like I've been talking for 85 hours. So anyway, look, if you have any comments or questions about anything I said today, any of the trades, please put them in the comment section. I'll do my very best to get back to you as soon as I can. I hope you have a good weekend. If you're interested in having me teach you, I would love to have you as a student. I'll teach you everything I know. I'll give it 110%. But for you to be able to learn a new skill in trading, learn things the correct way from someone who's been trading over 30 years, it's available and I'm here. So please just send me an email. We can get the conversation started. I've had a lot of students lately, Ben. I have just been teaching almost every night, but still try to make room and get you in. Yeah, reach out to me. But I appreciate you being here, everyone. I hope you found it helpful. Again, if you found it helpful, appreciate if you could hit the thumbs up button. If you could try to go out and do one nice thing for another human being every day, I think it would make the world a better place. Can you imagine if we all did one nice thing for another human? Everyone around the world did that. It would make the world a better place. If you could go out and try to do one nice thing for an animal, I would really appreciate that too. I was raised with many animals. That animals appreciate acts of kindness just like we do. So, enjoy the rest of your weekend, everyone. Again, be humble. I don't care how good you are or how long you've been trading. Go into the day being humble like you don't know everything. I'm telling you, in the long run, you're going to end up better than if you act like you know everything. All right? So, all right, everybody. On the way out here, I have to run the U.S. legal disclaimer. Thank you so much. And God willing, I'll see you next week. Take care. Bye-bye.
This video or live broadcast, like all instructional, U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.